Nasdaq looked calm, but the market underneath was not calm at all. The real story is not that stocks shrugged off another shock. The real story is that one powerful AI trade helped hide a much messier market underneath. Oil moved, yields reacted, Bitcoin felt pressure, and Wall Street suddenly had to price the same question again. What happens when inflation risk comes back before investors are ready? The trigger was the return of geopolitical tension around the Gulf, which pushed oil back into the center of the market conversation. When oil jumps, it is not just an energy story. It becomes an inflation story, then a bond market story, then a liquidity story. That is why the broad market looked weaker, even while the Nasdaq found a way to recover. The reason the Nasdaq held up was not because risk disappeared. It held up because Nvidia and the AI trade are still acting like the market's strongest liquidity magnet. A single dominant narrative can pull capital into one corner of the market while other parts quietly weaken. That is the kind of split tape Wall Street understands very well, but retail investors often misread. The mistake is thinking a green Nasdaq means the market is fully healthy. A market can look stable at the index level while leadership narrows underneath the surface. If oil keeps pressure on inflation expectations and yields stay firm, the question becomes whether AI strength can keep carrying the tape alone. At the calm metrics, this is where price becomes less important than the message behind the price. The takeaway is simple. This is not clean panic, and it is not clean greed. It is a market being pulled between two forces: AI liquidity on one side, macro risk on the other. For the afternoon session, the signal to watch is whether Nvidia-style leadership spreads to the broader market, or whether oil and yields start draining confidence from risk assets. The surface says Nasdaq survived, but the deeper message says the market just became more fragile.